So as I told you, after reading week, the course is going to change from a situation where no one makes money to a situation where people make money. And part of the facts that go with making money is to lose money. And today, what I want to do is I want to start with that. I want to talk about financial risk management. And it's not that financial risk management is fun. It's not that losing money is fun. It's that to this day, this is perhaps the area where a lot of you are going to be getting jobs. So I want you to be aware of what this is. To do that, I want to walk you through history again. Risk management today still is a reactive activity. There is very little proactivity in risk management. And as we're going to see, when bad things happen, then regulators and markets react. And that is how risk management has been built. Essentially over the last 100 years. I just want to focus on the last 100 years. I think they're going to be most interesting for us. And most of the lessons that I'm going to be talking about are linked to that. I remind you that financial markets are much older than that. Futures started in the 17th century. Stocks followed soon after, and so did bonds. But this is not the part that I want to focus on. I want to start with what happened almost exactly 100 years ago. That's the crash of 1929. I don't know how many of you are aware of that. I think we've talked about that in this class. I think I may have mentioned to you the movie It's a Wonderful Life. I will not get into the causes of the crash. I'll get into the consequences of the crash. The crash had very important, far-reaching consequences. I'll look into one of them today. But essentially what the crash did for us, it created the first wave of regulation, which was a response to that. I'll go through it in some detail. So it's going to be, as you're going to see, say, a chain reaction of things that happen, they get corrected. Something bad happens, gets corrected, and so on and so forth. After the crash of 1929, I think the most relevant event that we had in the 20th century, in the last 100 years, is the oil war, or so-called oil war, the U.S. oil embargo on Iran that created. It sounds very familiar to what's going on today, but it was different, very different, and very bad for the economy, the world economy, in the 70s. Especially when all of this was creating tremendous inflation and a very deep crisis. Just to tell you how bad this was, you remember, it's part of your time, the blow up, the default of Silicon Valley Bank. We went through that here. The same year we had Credit Suisse. Remember that? Well, this was a time when, for a period of years, we had 6 bank failures in the United States every year. Okay, that's just to give you an indication how bad these things were. Now, these things were so bad, volatility was so high, interest rates were so high that the markets reacted by creating mechanisms to remedy that. And the mechanism that was created that was very successful at putting a remedy to that was the creation of the derivatives market in the 80s. You came to this course, I suspect, having some understanding of the derivatives market. Some of you may even have traded derivatives. I want you to know that derivatives were created on the wake of this very big, sustained financial difficulties for the world economy. As we can see here, this is the graph of the Dow Jones Index, which is the longest index I could find for the U.S. economy. And the derivatives market was very successful. It grew a lot. It gave a lot of solutions to the problems that financial participants had. And then something happened. which I'm going to spend a lot of time on today, and that's the crash of 1987. Very few people know about the crash of 1987, and the reason is it lasted one day. It was very bad, it was very deep, it was 25% in a single day, worse than the 1929 crash on a single day. No particular reason why that happened. We will get into that today. But this created, and the markets recovered very quickly, but it was a deadly crash, because if something, the market index goes down by 25% in a single day, bad things happen. So the reaction to that is what is going to give us a lot of the reasons for the material I'll cover today. That's when risk management, the way we look at it here, really happened. It was all after that, and that defined the late 90s, 1998 with Basel I, 1999, 2000, and then 2001 we had two things: the September 11 event in New York, and also the bankruptcy of Enron, which also had some consequences. Not too relevant for this course, but we'll talk about that. But the result of that was the quantitative easing that the Federal Reserve in the United States did, which is essentially giving, as some people say, giving free money. It's not really free money, but it is a way to provide liquidity to the markets that has the impact of lowering interest rates a lot, because interest rates were dropped so much that gave rise to the growth of something else, and that was the growth of the structured credit. And when structured credit started to grow and grew, then, as we mentioned at the end of the last week, this gave rise to new financial instruments that were not very well understood, that were perhaps mispriced, and gave rise to the greatest financial crisis we have had in recent history, which is the 2008 financial crisis. It was very deep. It was very bad. We're going to see some examples of that towards the end of this course when I tell you about trading strategies and how investments, because a lot of the investments that were developed in 2008 were also as a way to get out of this problem. So as you can see here, there's a chain reaction of something bad happens, the market reacts. Something bad happens, some market reacts. And every time you create a solution, you create a new problem. For example, the derivatives market that was created as a solution to the problems of the 1950s and 1970s is what gave rise to the 1987 crash. Because the 1987 crash was actually driven by derivatives 100%. The problem that derived from the Enron bankruptcy and the mini recession that was that happened in the United States, also in relationship with the September 11 attacks, gave rise to low interest rates that solved it, but that created the structured credit bubble that blew up in 2008, and so on and so forth. That which is very important to understand the sequence of events, because not only the theories we'll develop here are part of that, but your job, when you have it, will be part of that sequence. You want to be where in that sequence you are. Very likely, if you get jobs in risk management, your job will be there because of something that happened some time ago. And it could be any one of these things. And I recommend that you know what events led to that. It'll help you understand your job better beyond the day-to-day. And strategically, it will be the right move for you. So to summarize some of the events that happened here, what we have is the 1929 crash that gave rise to the Securities Act of 1933. Not too relevant for this course today. That's going to be very relevant for the course on investments that I'll start in a few weeks, because this really changed the world of investments. But I'll touch on that today a little bit. Then we had the oil war of the 50s and 70s, and that gave rise to the creation of the BCBS, the Basel Committee on Banking Supervision, okay, and which is like the bank that brings together all of the nation regulators. So every country has a regulating body. Here we have the Bank of Canada for money. We have the the different banking agencies, which in Canada are provincial, all of those regulators, the Federal Reserve Bank, the Bank of Japan, they all formed, as a consequence of that, the Basel Committee on Banking Supervision. So Basel is the world capital for banking regulation. Basel, that's the B, the first B in Basel, okay? Rhymes with bank, B. All right. Then October 1987 is this single day crash that gave rise to the first regulation of Basel, which is Basel I, the Bank for International Settlements, which was put into place on January 1st, 1998. Prior to that was the BIS treaty that the signing countries, Canada was one of them, agreed to participate by bringing their local financial industry along the lines of what then became BIS-I. That happened in 1991. And for those of you who are in my Risk Lab, you should know I created a Risk Lab in 1996. It's our 30th year anniversary this year. And I did not know this, but I created the Risk Lab at the right time. It's when all of these things were being developed. I got lucky. If I had known, maybe I would have been even more lucky. But I learned this only after I did my Risk Lab. So you have the advantage that you know these things now ahead of time. I wish I had known. I was doing well and I didn't know why. I learned that later. That was luck also. So it's good to be lucky. There's no course on being lucky, but it's good. And then in 1998, this is only 8 months after the first regulation was issued by BIS-I, then we had a very big event. That was an event which, there was actually two events. They all happened the same week. First, the Russian default on their debt, and the same week was the impeachment in Congress of Bill Clinton because of the Monica Lewinsky affair. That threw markets into a tailspin. Actually, not a tailspin. That froze the credit markets. No credit happened. Investors were very concerned. They didn't know what was next, so they stopped. And that had a very big impact on a particular fund, a long-term capital management, that we will review in some detail in a few weeks. And that was it. It was about $1 trillion worth of U.S. debt. Was bonds, sorry, about $1 trillion worth of U.S. bonds were a victim of that. And now $1 trillion is not so much money. It's not what it used to be. $1 trillion used to be a lot of money. Okay, now it's just a small percentage of the U.S. debt. But back then was very bad, and well, some actions had to be taken to fix that, and that gave rise to a Basel II that was enacted around 2001, which is when Enron happened, and that gave rise to Sarbanes-Oxley in 2002. Not too relevant for us, but you see, it's always like that. Then 2008 gave rise to the Dodd-Frank Act that Obama said, and then Trump basically repealed. And your job will be here in some of this. For many of you, your job will be as part of this sequence. Another thing that will develop, we don't have a data regulation event yet. I suspect it's coming. It's probably related to maybe cybersecurity or something like that. As you know, there's a lot of activity on quantum security. Your banking apps with quantum computers will probably stop working. The banks will shut them down because they're probably not safe, not secure, right? So that's going on. We will see. We all lived through COVID-19. It didn't really give rise to a lot of regulation, although there was, for many years I've been a member of the Professional Risk Management International Association, and back when we had the SARS event, you were probably very young, we already started to discuss about the pandemic risk and what that would look like, and nothing ever happened with that, not even during COVID. So maybe one day we'll have that, maybe not, but that, who knows, it's there. There we have the event, we don't have the consequence. And one that will be very important for the second half of my lecture today is Article 2.1c of the Paris Accord, which falls under the framework of climate risk. I will talk about climate risk today. Yes?
I'm just curious what aspects of the Dodd-Frank Act were repealed by the Trump administration?
Oh, very simple. Because it limited the bank's ability to make money.
I mean which aspects of the act?
Oh, many. It's a very long regulation. It's more than 2,000 pages. For example, I actually don't know. I'll have to look it up which ones were repealed and which ones are still there. But the crux of the Dodd-Frank Act of 2010 is that upon review of some of the bad things that happened in 2008, which we will view in some detail in a few weeks, when we talk about investments, we'll talk about 2008 as from an investment perspective, not from a financial risk perspective. For example, that limited the bank's ability to do trades. This actually, so the first wave of the Dodd-Frank Act, what it did is it removed the prop desks from banks. And I announced that to all of my students because many of them were hoping to be traders in banks. I said, forget it, those jobs don't exist anymore. Those jobs moved into hedge funds. A lot of the people that were doing trading for the bank, trading the bank's money, because of the fear of something that happened in 2008, which is that you use your knowledge as your bank, as being in bank, to trade against your clients. That happened. Goldman Sachs was caught in a number of those situations. You understand what I'm saying? Okay, so you have your client comes to you and they are somehow looking for some protection. I'll give you protection. Yes, I'll give you protection. I'll sell you something that I know is not going to happen. We went through the Procter & Gamble example with the Bankers Trust. I'm exaggerating. This is not what happened in 2009, but there were situations where the banks were trading against their clients, making money on their clients, not only because they pay you a fee, but because you can actually trade with your own money to favor yourself. So some of those things were repealed. Okay, and one of the reasons why Trump was very popular with Wall Street for a while, because of that. It allowed banks to continue to do some of the business they were doing earlier. Okay, but if you are interested, to fully answer your question, I should verify my information first, and then I should explain to you what it is. So I don't have time for that. But if you're interested in that, that you probably have to use ChatGPT for that, because a lot of this has not been published. It's all published, not in a book. I cannot tell you a book to read about this. This is too recent, okay, and too specific. Good question. Yes, which I can't answer. Okay. All right. And so today I'll mention something about climate risk as part of this, because it is giving rise to new financial instruments. So today I'm going to do something that it's not, I hope you don't look at me from an ideological perspective, but I will talk about climate risk as a way to make money. You'll understand. Allow me to not say anymore. Just don't judge me until I show you how I deal with that. Okay. So I'll give you the history of financial markets. I'll give you a very short history of risk analysis for the last 100 years. And I'll start exactly 100 years ago with the publication of a book, which was the book that gave rise to what we now call value investing. And value investing, some of you would know. We'll get into that also in some detail. This is just a big preview of what is to come later. Value investing was the exercise of buying the best stock at the best possible price. That's my way of simplifying that. That's that activity. That's what it was. And then came the concept of risk. Risk was, for the first time, introduced in financial markets around 1950 by Harry Markowitz, which again, we'll see all of these in great detail. But I want you to reflect on one thing. Look at the years, 1900, 1950. Actually, 1930, 1950. I told you in 1933, we had the first wave of regulation. One of the things it did is it forced companies to do proper accounting and to report numbers that people could believe. How would you probably know a little bit about investing. How could you do a little bit of how could you invest if you don't know the numbers that companies are giving you?
Speculation.
Yeah, but you have to speculate on what? You have to, look out the window and you have no information, right? A company could give it.
From the broker?
If the company, how would the broker know? Imagine I have a company, right? I call myself IBM. And I tell you that I have billions and billions of profits, right? Who will know that I'm lying to you?
Get some insider information.
Hmm?
Get some insider information.
Because I have some inside information. Is that what you're saying? Even inside the company, it'll be very hard to know who's telling the truth, right? If you don't have data, or worse, if you have bad data, how can you make decisions? So the big change that happened in 1933 is the data that was published had to be correct. If you lie, you go to jail. That was one of the innovations introduced in 1933. You understand what I'm saying? For the first time, accounting is very old. It's 6,000 years old, but you could lie. So if you can lie in your accounting, what good is it? It's good for you, but when you communicate that to others, how good is that to create a market where people bid for shares in your company if the numbers you produce could be manipulated, right? Sounds familiar? Manipulation of information? Well, that was legal in the 18th century, right? So when that changed, well, now that the data is something I can trust, then I can make decisions. And that's why value investing really developed in the 30s. It's great. But then Markowitz came in the 1950s and said, well, I think I'll focus on risk now. If he had said this in the 40s, we would now know who he was. He won the Nobel Prize. He did it in the 50s. Why? Because as we will see today, to do risk management, you need computers. You cannot do risk management by hand. He introduced the concept of time series and how time series can help you analyze risk. How can you do time series with pencil and paper? Even if you're very fast punching numbers in a calculator, you can't do it, right? So there's a technological coincidence going on through this development that I'm showing you here. The next one that happened was the arrival of the personal computer. What happens when everybody has a computer? You don't have to rely on the big mainframe. You have to go to an obscure room at your university to access a computer which you share with 100,000 people. What happens when you have your own computer? You have it with you all the time. You create your own models. People learn programming. People learn how to use Excel. It democratized calculations. And then what happened? Well, everybody had their own models. And that's what we have seen. The biggest amount of models, everybody had their own trading system. And everybody traded on the belief of their own trading system. Okay? So that's what the personal computer did. Then in 2020, something happened that is very big. And that was the arrival of machine learning. And that is something which is revolutionary. We're still beginning to see the effects of that. And what that did is it changed the data inputs. Everything up until 2020 was done on data inputs, which were just numbers. From 2020, the good inputs are numbers and words, textual information. Because of that, you can start to be aware of things that were science fiction in the 50s. Like, for example, me knowing what you think. Me knowing what you're about to buy, so I can buy it first. I can front run you legally. And the best example I have here is GameStop. I like to talk about GameStop because if you really wanted to understand what was happening with GameStop in real time, you don't go to Bloomberg. Where do you go?
You go to Reddit.
You go to Reddit, right? Now, of course, if you're a human reading Reddit, you're at a disadvantage because you read very slowly, right? And this, I think, is the biggest change we are seeing in finance today. It's still being developed. The changes are not all here yet. Don't forget, DeepSeek was created by a Chinese hedge fund. You trade on textual information today, which allows you to track social behavior. And in a certain sense, the analysis that people did 100 years ago, they say, this company is great, it has fantastic financials, this company is very bad. GameStop, very bad. It has no internet business plan. They're not gonna survive. And who cares? Who cares when 10 million people think the opposite? And these are people that don't even have billions to invest, right? They invested $1,000, $5,000. That's enough to make the value investing of the 30s useless, right? And this is the biggest change that's happening today. I am not going to say a lot about this because these changes are still happening. I will make you alert of what's going on. But it's in the context of that I want to talk about. This is the science fiction part of my course. And it's science fiction because I'm convinced that this is going to happen, and I have something that I think I know, and I can probably give you some advance warning, which is the effect that things such as, I will use climate risk, but there's many more things, are going to do to financial markets, because they are creating what I think is the biggest wave of investable products that we have seen. Okay. I'll tell you a bit more about that towards the end. I want you to be aware of that. That may be what I will say in the second half of today's class is perhaps very controversial. It's very new. Very few people know what I'll be telling you about second half of today. Okay, and that's related to that. Let me just say that Article 210 of the Paris Accord, the only thing it does, it's very simple. It states that financial mechanisms will be used to achieve decarbonization. That's what it says. That means that finance has a whole new chapter. Very similar to what happened to derivatives in the 80s. When you say that financial mechanisms will be used to get rid of all these problems we have here with the oil embargo. Okay, I'll tell you more about that. That's coming. Now, when we talk about risk, we have to talk about risk taxonomy, the different types of risks that exist. Usually people talk about risk when it's about losing something that you paid too much for example. This is what's called market risk. These are losses that come to changes in your net asset value, changes that can be recorded as your P&L function, your profit and loss function. But there's also credit risk, which I'll spend 2 whole weeks on starting next week. This is the risk that nothing goes up or down in price. What happens is that someone who has to pay you, they decide not to pay. And that's something that everybody has the right to do. Every company can go bankrupt. That's one of the big changes that happened in the Industrial Revolution. British law was changed to allow for companies to go bankrupt. The limited liability notion of a company was introduced as a necessity for companies to grow. There would be no way companies could be created without that. And the company I like to use as an example of that is a company that is no longer with us, very sadly, as the BEI. I don't know if I told you about. Do you know the history of the BEI? It's one of the first companies ever created. It was actually created even before the London stock market. And it was up until the Industrial Revolution, people had enough money to do companies on their own. But big enterprises with Industrial Revolution, they were too big for a single person to take over usually. So they had to get together in a company. Okay, so, but then companies had the ability to not pay, they go bankrupt, right? And that's new, that was introduced by the Industrial Revolution. Prior to that, no, if you owe something someone, they can take everything you own, they can take your family, slavery was allowed. That's it, that's how you pay for your debts, right? You become a slave. In the Industrial Revolution, that was changed. So credit risk is now there, it's with us, and we're going to talk about that for 2 weeks. There's still a lot of jobs in credit because it's very hard. Then we have other risks. Liquidity risk is how fast you can turn your assets into cash, into liquid cash. You have to send a quick transfer. How can you do that if I will talk about legal risk. Things change. I think we reviewed the case of Bankers Trust. That's an example of legal risk. Imagine the judge had decided that options trading was gambling. Derivatives market would either stop immediately or move to, I don't know, the Bahamas or somewhere. Some country would have said, no, we do them here. I'll become the clearinghouse of derivatives. I'll make them legal in my territory. That country would be very wealthy now, right? And others wouldn't. And then operational risk is a catch-all phrase that mistakes, fraud, this and that goes into that. This is very, very hard. The regulators, Basel had the attempt to regulate this a few years ago. They gave up on that. It's just too hard. It may come back in the future. I don't know. We will see. And within the taxonomy, there is, I think I'm going to go quickly through this. There's a lot of ways we can classify risk. Let me just give you the very quick summary of that. Within market risk, we have seen different big waves of regulation. Basel I from 1988 in the banking industry, then Basel III that introduced the financial review of the trading book. There's still jobs there in these areas. On the insurance, this is all part of the Solvency II, which is affecting world insurance markets. And credit risk has had its, here I codify these entries with colors. Red is regulated, black is unregulated, and green is an interesting one because green is a type of risk that actually makes companies money. Okay, so we can just go through this. This is perhaps not too relevant for today, but perhaps let me give you an idea of the depth of field that we could have here if I was to look into all of these things in great detail. Okay, I could easily spend there are courses that's all they do in the whole course, just explain this slide. Okay. But here's just the slide cybersecurity is a big deal. We don't really know much about that, but it is one of the areas where every chief risk officer spends most of their time today. Okay. So, and as you know, this could be, I mean, there are entire courses on cybersecurity. So this entire course on just one of my lines is one of my tables. I want you to have a big view of that. And then these things, business cases, which are well known to represent those. If you want to understand any of the lines that I mentioned there because you are doing a job interview in that particular area, do yourself a favor. Go back to my lecture notes, see where in that table you are, your job is going to be, and then look at the business case that corresponds to it here and ask ChatGPT to give it to you. Learn it. Your job interview will make a lot of sense when you go through these cases, okay? I don't have time to go through these business cases, but here they are for you. Just type these names into ChatGPT and learn how they work. And that will give you a good idea of what your job would look like. Understand what I'm saying? Good. Some of these I will touch on my courses. Now that we're making and losing money, it is for real. I will switch a lot of my mathematical discussions for what happened in prices and then bring the math to those cases. So I'll talk about Volkswagen, the short squeeze. I'll talk about Bernie Madoff. I'll talk about long-term capital management. I'm not talking about the Malaysia Central Bank, very famous case in cybersecurity. How some people, we don't know who, stole $80 million from the Central Bank of Malaysia. Very interesting case in cybersecurity. And if I focus now on risk management, which is the first wave of risk, there are not a lot of jobs on market risk management right now. Okay, but there's a lot of jobs in credit risk management. Let me show you how that worked. So the first, the start of all of this was on October 19, 1987. A day where in a fairly completely unannounced manner, the market dropped 25% and trading got stopped. And as soon as trading stopped, what happened here? People did not know. No economic news, nothing. It just the market dropped. Why? A Brady Commission was put together by the US Congress, and then they found that what had happened is, I may have mentioned this in the past, This was the beginning of computer-driven trading. People have implemented trading models for option trading in computers. To such, and what happened was a coincidence that a lot of the computers were taking the same buy or sell signals. Volatility started to change. These models, as we have seen here, are not really prepared for volatility that changes too fast. They started to see arbitrage opportunities where there weren't any. They started to buy, sell in big volumes. That exacerbated the market volume, and in the end, it was a big collapse. Okay. We have seen things like that. The flash crash of 2010, I think. I forgot now. But these things they tend to happen. Okay. So, but this was deep, and what regulators did is a very simple observation, one that is not new to us. We've already seen it. If we go back to the 33-cent game for a few seconds, look how interesting that game is. I still call it a game. We know it's not a game, it's a call option. Look how interesting it is. In that situation, if the stock goes up by 100% from 1 to 2, my option value goes up by 300%. And if the stock drops by 50%, my option price drops by 100%. It's a nonlinear instrument. And you yourselves, you could all come up with other types of securities that will be even more lethal than that. Right? You can change the expiration date, you can risk management up until 1987 was a linear exercise. I don't believe that in my course. It's very simple. Banks, you say, how many assets do you have? I have 500 billion. Okay, then 8% of that, 40 million, goes here into your regulatory capital. Imagine that, I'm exaggerating, but imagine you have 500 billion on that one stock, on that one option. If the market does a little bit, then you're going to lose a lot. So the realization was that you needed a non-linear risk management system. I'm being a little bit metaphorical here, but you understand what I'm saying. The risk management systems there had to become non-linear. We're going to see what they became. And you're going to see that because of that, mathematicians had to be called. Okay? So that happened in 1987. In 1991 was the treaty, the Basel Treaty, that said we have to do something about this. Then JP Morgan was very smart, and they provided a proposal, that's the RiskMathics methodology, some of which we will see today. So how about this? And so the regulator said, oh, thank you, it's already done for me. And that essentially became the first wave of regulation in December 31st, 1997. Don't forget, this is something that was proposed by a bank. So in the 90s, this is a document you should all know by heart. Now it's not so relevant. And then in anticipation of what credit might be, in 1997, JP Morgan again created another new risk management framework, the credit matrix document, that we will see in some detail in 2 weeks. 1997. And in 1998, we had the event that made regulators wish that framework would have been in place already, okay? And that was long-term capital management. But it wasn't in place. It went into place 3 years later. And by the way, lots of jobs happen after that. Credit markets are very big, and they're very profitable too, by the way. Note that most of the activities that banks do is they lend money through credit cards, mortgages, you name it. Right? So they have to be big. And so then Basel II developed, which regulated credit, and then after that, in 2017, we had the Basel III. Basel III, which is very complicated, very long, lots of new items, and it introduced operational risk for the first time, but that has been removed now. When I look at the investment industry, I'll just say a few words about the regulation there. In 1929, we have the crash. That was followed by the Investor Advisors Act of 1933 and the Exchange Act of 1934. The Exchange Act is the one that regulates the function of stock markets. They didn't have function, and a Securities and Exchange Commission was created as a consequence of that act. The Securities and Exchange Commission did not exist. So the stock market was largely unregulated. You could buy and sell. Insider trading was allowed. There was no problem with that. It was just completely. Then Enron happened, and then we had the Sarbanes-Oxley Act of 2002, and then the credit market happened, the Great Recession as it's called, and then the Dodd-Frank Act. So this is the evolution of the asset management industry. I don't have this for the insurance sector. If any one of you gets even a job interview in the insurance sector, you should try to do the same for insurance. Okay, try to understand the evolution, try to understand Solvency II, try to understand how if your insurance job is going to be in Canada, in the U.S., China, they're all different. Okay, and just to give you a clue how things were prior to 1929, I told you I'm not going to spend a lot of time on this, but I'll give you some notions. So the crash followed a highly speculative boom that started in the 20s. They call it the Roaring 20s, and this is what happened after the end of World War I. Volumes went up a big deal, and in fact, the amount of money that was on loan for people to buy stocks was more than the money that was in circulation. It became everybody's favorite game. And the average PE ratio before the crash was 32. It's a very big number. People were paying a lot for companies. People were doing this without really understanding what they were doing. But the interesting part for me here is the fact that insider trading was legal. And the Albert Wiggin, the head of the Chase National Bank, shorted 40,000 shares of his own bank when he saw what was coming. And that was okay. You could do that, okay? You could tip people off with true or false information, and that was okay. That was okay. That stopped being the case in 1934. The Basel Committee of Banking Supervision was created in 1974 in the heat of all of this big problem on the post-oil war between the US and Iran. And this is one that I mentioned to you. This is what I mentioned earlier. The risk capital that they did in 1974 is 8% of your capital as a bank was your regulatory capital. That's it. There will be no course, no APM 466 or MAT 1856 course with that rule in mind, right? Everybody knows how to do 8%. Well, today we're going to see what this 8% was replaced by. And that's the big thing I want you to be aware of. Okay. These are the different instruments. I'm just going to go through this quickly. This is how this was calculated. Everybody can do 8%. That's not what I want to spend time on. And then October 19 came, October 19, 1987. This is the biggest single-day crash we have had ever, okay? And it happened because of this reflection that we need a nonlinear risk management system. And what was created is a concept called value at risk that I want to spend a few minutes with. Some of you may have heard that. The concept of value at risk is, I'll give you the mathematical definition, but basically what it became is an answer to the following question. How bad could things get for you? If you look ahead for the next month, what's the most you can lose next month? This question signifies a revolution. No one was asking questions like this prior to 1987. in fact, if you ask that question, you are deemed a lunatic. So who knows? I have no idea what the future will look like. So the realization was that, well, we need to know. We need to know what these things could look like. And that opened the door to the world of probability and this and that, and which is the reason why a lot of these jobs exist. What I like to say is that for the first time, mathematical terms were made into law. Before I tell you how this was done, I want you to understand something about the law. You're used to, you're taking math courses, right? And when you do the exam, they say right and wrong answer, right? You do an exam, they say, oh, you made a mistake here. So, oh yeah, you're right, made a mistake. Or no, I didn't make a mistake. You can argue, right? But there's an accepted principle. We all accept what math is. 2 + 2 = 5 is wrong. We agree, right? That the antiderivative of x squared is not the square root of x is wrong. I mean, that's a right statement. Okay? The antiderivative of x squared is not the square root of x. We agree on that, right? Of the two statements, which one of them can you convince a judge which is right and wrong? Which one? What if I tell you that the solution of the heat equation is given by a linear function? You know it's wrong too. But in the realm of law, it's the judge that decides. And judges don't typically have a math degree. So how do you do that? The challenge here is you have to create mathematical objects into law that can be defended against the judge. And I have to say I teach a lot of courses to mathematicians, and I always like to teach courses that are useful outside of these windows. And the things that we take for granted, that we know are true as mathematicians, are sometimes not relevant when you go out there. Because you have to convince a judge. And convincing a judge is a matter of process. It's not a matter of arguing. You don't argue. It's a process. And law is a process. It's not about who's right or wrong. It's who follows the right process. So turning a question like, how bad can things get, into law is extremely difficult. Very, very difficult, okay? And I want to spend now a little bit of time telling you how this was done in such a way that, as you will see, you can calculate it and you can defend it with people that know no math. And I'm giving an answer to a question where it seems very difficult. What will the future look like? So first I'll give you the mathematical definition, the one that we would use amongst ourselves to talk to each other. And the answer is this concept called value at risk, which is my risk of losing money, is how much money I could lose, is defined to be it's a quantile. You're familiar with quantiles. You've seen quantiles in your, okay. So it is the number that I pick, I call it value at risk, will be that is my 95% quantile of my loss random variable. You all understand what that is. This is the number that I have a 5% chance of losing more than it. I want to give you an example, a very good example. This will be the mathematical definition of that. If I have a loss distribution given by a mathematical function, rho, then the value at risk is that number. So if I look at my losses up until that happens to be 5%. So I use a confidence interval, which is typically high, 95%. So the value of that integral is 1 minus 95%, which is 5%. Okay? So you understand this. You've seen math. You know the integral. You know all of this. This is how a mathematician would approach this definition, right? Yes? All good? Great. Okay, but how do we write this into law? How do we write this into law? If you look at a legal document, you will never find that integral. As you will not find the word probability in it either. Because those things, who knows what the probability is, right? How can we write this into law? Let me spend a bit more time on the math of it. In the math of it, I'm going to use two objects, the cumulative distribution function, and I'm appealing to your mathematical knowledge. I'm not attempting to write this into law yet, okay? I want to explain this a little bit more. And then you know that the probability density is the derivative of the cumulative distribution function, right? They're all related to each other by that expression. This you know. This you know. Note that the value at risk is given by the green curve, right? That's the quantile function. You pick your quantile on the y-axis, say 5%, and then that'll give you a number x on the x-axis, which will be the value at risk. And that's how you would do it. Mathematically, this is how we would do it. Are we able to turn this into an expression that could be written into law? Let me give you an example. Let's say that I have a very simple portfolio. I issue 1,000 lottery tickets. Doesn't matter how much I charge. That's not the issue because doesn't affect my losses. Let's say that the winner, there's only one winner, will get $1 million. So if I want to do the value at risk with 95%, let's go through the number of tickets that we issue and the losses we have in that situation. If I issue one ticket, what is my value at risk? 0. Because the probability that I lose anything is less than 5%. If I sell 49 tickets, my value at risk continues to be 0. If I sell 50 tickets, my probability jumps to $1 million. And if I sell all tickets, the value at risk continues to be $1 million. Understand that example? The example is very important. We're going to have to find a way to write this into law. By the way, we're going to write this into law, okay? Don't worry about that. But note one thing. This is going to be very important, and people knew that. Imagine my value at risk is $1 million. Imagine I'm a regulated bank, and I sold 50 tickets. I say, how unlucky. If I had sold only 49, I will have no regulatory capital. And banks like to have low regulatory capital. It's not that they don't like losses. They just don't like to keep that money with someone else's possession so they can not do business. They want to do business with their money, right? So what you could do is you could turn your bank into two banks. And you give 25 tickets to each of them, right? Then each of them will have a value at risk of 0. Are you following me? And this is something that banks did, not just banks, everybody did this in the 2000s, which gave rise to the credit bubble. It was a way to hide risk. This definition gives you a way to hide risk. We'll see more about that in a minute, okay? So what the RiskMathics methodology was is a way to turn this into law. That's what it was. And I'm going to do that in different ways. First, I'll give you some mathematical terms and some mathematical definition, and then I'll show you how these things can be turned into law. The key here is this. What we could do is we could take a portfolio. A portfolio is something which is given, and everybody knows what it is. You can publish it. It could be very complicated. It could be a portfolio of bonds, stocks, loans, mortgages, this and that, right? The one thing that banks would have to do would be to have an agreed way to value that portfolio. But that's not new. That was done in 1933. Accounting was introduced. So the notion that you could value your portfolio as a function of what I have here 100 yield curves, right? You had 10 in your assignment 1. Here I have 100. So if I go back to your assignment 1, if I have a bond portfolio today, I could ask you to replace that portfolio with the 10 curves that you calculated yourselves, right? You could all do that in a defendable way, because the pricing of your portfolios as a function of those curves is something you can regulate, right? So let me do it with 100, not with 10 that you did, but with 100. If I do that, then I have a well-defined set of profit and loss numbers, right? And this is something that is at the same level of accuracy as any financial audit. So it's something that you can do. Auditors, accountants do this every day. You can do this. So let me ask you a question. I don't know if you can see, you cannot see the numbers, right? Can you see those numbers there? From where you are, you can see those numbers? Okay, then tell me what the value at risk is. It's an exercise in I guess you have to use your visual neural network. Who can tell me what the value at risk is? Here. No programming, nothing, no calculations, nothing. You can see these numbers, right? Yeah? Who can give me the quanta?
Sorry, how many data points are there again?
Sorry?
How many data points are there?
100.
100.
100.
So then just the top 5?
The bottom 5, right?
Sorry, yeah, bottom 5.
It losses, right? So that'll be 1, 2, 3, 4, maybe that one, maybe that one. What number is that? -6. That's it. You can write this into law. Right? You understand what I'm saying? You understand what I did? Great. Okay. So, but why then do I have to hire mathematicians to do this?
It's like you have to like know what's happening first to like put it into simple terms.
Because this is part of a very complicated set of circumstances. For sure, that's how you define it. For sure, that's how you're going to be reporting that to the regulators, and someone will write a check for that amount of money, for sure. But what's going on behind the scenes? So you don't want to just be hostage to these numbers. To the bank say, oh, my value at risk today is such. What? How did that happen? I don't know how it happened. So you don't need anybody. You don't need mathematicians to calculate this. That's why it can be written into law. But you need mathematicians to manage it, to keep it low. Because this thing that we're doing is, as you know, this is part of a probability distribution. And although this is not part of law, this is what the banks do. In fact, many of you will be doing risk management jobs and not be lawyers. Because a lot of these things, you're going to live in a world that gives rise to the final number. So the final number to be consumed is maybe a number that you're not involved in. You're involved in the production of that number. Not the legal production of the number, but the internal management that keeps that number low. We're going to see examples of this. We're going to do trades in this course where that will become very, very clear. And you will see that having the math insights into this is what you need to keep these numbers low. Then they will be done through a legal process. But it's the mathematical nature of these numbers that open the door for mathematicians to be hired. And many of you will be getting jobs not because of the way these things are defined into law, but because what's behind it. And that's what I want you to be aware. Okay? All right. So let me give you some practical situations where we can calculate, and then we take a break. Actually, I want to take a break I want to do one break today, even if it's a longer break, because my course has two very clear. One is about the past and one is about the future. So when I'm done with the past, I'll take a break and then I come back and I'll talk only about the future. Okay, science fiction. But let me go through some of these examples. I'll go quickly through this. I don't expect you to be able to do these things in your head very quickly, but just to give you an idea of how these things work in practice. And again, this is now not about the reporting of the value at risk, which we agree can be done legally, defendable in front of a lawyer, of a judge, right? But now let me get into what makes these numbers. How would a mathematician think? So imagine I have a portfolio that has a Gaussian profit and loss function. We already know this is not crazy, right? And if the cumulative distribution of the Gaussian is denoted by phi, then my portfolio is a number which is given by the mu and the standard deviation. That's all I need to know about the portfolio. What the portfolio is made of, I don't care, right? So that helps me think about the portfolio in very, very simple ways. And then I know what the value at risk is, because it's the quantile of a Gaussian. And we know it's 1.65 times the standard deviation. That's how it works. That's how the Gaussian distribution works. Right? Very simple. I don't need to simulate anything. Someone in the risk department will have to do the simulation and report that to the Bank of Canada or whoever. Right? But before that number goes there, I could manage it because I know where it comes from. And it's a very simple number. That's in my portfolio is Gaussian, all right? If it's not Gaussian, then there's things that we do. But let's stick with the Gaussian because I only want you to understand, not how to calculate this number, but what's behind it, which is what your role would look like if you have a job in that department. Imagine I have a portfolio with one asset, $5 million, to a stock ABC, and the stock has a volatility of 2.88%, then you know that the value at risk, after it goes to the calculations, you don't really need to see the calculations. You know that the number is going to be about $246,000 because you know the Gaussian distribution, right? Someone in the risk department will be doing the calculation that will be correct, but it will be very close to this, and you know that. You understand what I'm saying? This is probably the easiest probability example you've ever done. Well, that's how you would do the value at risk calculation for a Gaussian portfolio. And then you annualize this to get 4-point-something million. That's how you do it. So the mathematical knowledge is very useful because it helps you understand the number that will be ultimately be calculated. So for example, if you have a way of reducing this number at a good cost, then you would probably do it because it simplifies the number you're going to get at the end. This is something you can understand, you can work with. The number in the end, which is reported, by the time this gets to the risk calculator, is too late. That will have to be calculated and sent to the regulators, right? Your work will be before it gets there. Perhaps authorizing transactions that would make that risk number to be very big and perhaps damage the profitability of your P&L. Yes? And this is in the simplest possible case. Of course, these things would get very, very complicated if you have very complicated portfolios in front of what you're doing. So all of this can be taken to multivariate Gaussians. We saw that in the very painful lecture we did before reading week, right? We've seen that already. So we are already masters of this, and now you could have an orgy of risk calculations, and you understand where everything is coming from, and you have variance, covariance matrices, and all of that. We've seen all of this. So we could take this to a great limit, and we could do amazing things. I can even calculate the risk of a portfolio of things purely from an analytical way. So when it gets to the risk calculator, which is then too late, I already know what number they're going to come up with. Because this is how the sum of Gaussians becomes a Gaussian. You've seen this, I suspect, at some point in your career, right? And then you see the effect of correlation. You see that correlation will drop. Correlation will drop the overall volatility and therefore will drop the overall value at risk, and you know that. And the advantage of this we've managed to decouple the reporting, the regulatory part of the exercise, which is someone hitting a calculator and calculating exactly the number that you have to send to the central bank as your risk capital, and everybody which is involved in the process to understand what you might have to do to make that number low. Because that's how this happens. So if you work in a risk department, you will be involved somehow, you will be somehow involved in some of these things. And then there will be people in the calculation department that may be accountants, lawyers, who will be doing the actual reporting. And your numbers will look very much like that. And if they don't, someone's going to call you. What happened? I expected $1 million, I get in 3 million. Why? Oh, I don't know, let me look. And then at some point in your careers, you will get promoted. You're not going to be doing this for a long time. Please don't, okay? This can get really to your nerves. You get promoted, if you're lucky. But if you get promoted, maybe you should really know the other people's job too, because now they're reporting to you, right? And then maybe some of you decide that you want to become lawyers. And some of my students have done that. So if that thought crosses your mind, don't dismiss it. There may be something there. Understand what I'm saying? So this will give you that clue. Great. You can well, have here how you could do this in n dimensions. Let me just go quickly to the example. I have one example that I want to show you. It's the same. I mean, you know that the sum of Gaussians is a Gaussian. So if I have now two stocks, ABC and DEF, and I have 5 million in one and 8 million in the other, and I know their standard deviations and their correlation. I need a correlation, remember? Yes? The sum of Gaussians I need to know the correlation to be able to know what the resulting Gaussian will be. Then I know that the daily volatility of our portfolio is given by this expression. You're not surprised by seeing this expression. You've seen it before, right? So the answer is $210,000. You annualize this. No, sorry, the 1 day value at risk will be 140,000. You have to multiply that by 1.65, which is the Gaussian of the which is the cumulative of the Gaussian with a 95% confidence interval. You know that? And that gives you a 1 year value at risk of $6.5 million. So you're in control of the numbers before they're produced. That's the engineering that has to be done. Yes?
So the square root of 365 and this volatility coefficient, they're both needing joint Gaussian, right? Because like the variance.
Oh yeah. Yes, absolutely. Yes. This is like chapter 1 of this whole thing. Then of course you can imagine. Of course, this could get infinitely more complicated. So then that's why it's not enough that you know a little bit of probability. Okay. And by the way, it is true from the mathematical perspective. This can get much more complex. But I haven't talked about the finance. Portfolio of 2 stocks, really? This does not look at all like a real portfolio that a real company would have. And frankly, where you're going to see the biggest sophistication is not in the math, it's in the portfolio. Which is why in my courses I always like to emphasize the finance aspect, because I'm usually teaching mathematicians who already know the math. And you have to be ready to, this is just a metaphorical example, right? And many of you can see how the math can get very out of hand. But now, look at the portfolio. Imagine that this portfolio is a basket default swap, or in the case of 2008, a whole bunch of tranches in CDOs, right? And then the example I told you at the close of last week, with how copulars were used and this and that, well, that fits into all of this. Correlations would then be replaced by copulars. My stock portfolio will be a bunch of CDOs or tranches in CDOs and this and that, right? You see that? Well, this landscape we see in the distance, that would be the job for many of you. And I think you're now prepared for that, okay? I think you're not prepared for that. Some entertaining facts. This formula, Stephen is gonna become a good friend of ours in a while. It's a way to, I don't know if you've seen this formula before. It is a coincidence. The volatility of a Gaussian portfolio, which is Gaussians with weights W and a covariance matrix V, can be written as what seems like a linear decomposition of the weights times the partial derivative of the volatility with respect to the weight. This is a good exercise of multivariate calculus. It's an exercise in calculating partial derivatives. You do it, okay? But what's interesting is this gives you almost an accounting interpretation of risk as a weighted sum of some new numbers that just came up, which are these partial derivatives that an accountant will call the marginal contribution to risk of that particular asset. We know it's not true because this is not a linear system, but it looks like one, right? So many investment decisions are made with this thing in mind, and that just gives you a flavor of the kinds of things that you deal with when you're doing risk management. I'm going to end with some thoughts that we already saw earlier with the lottery ticket, that if I have a portfolio, I can break it down into two, and then the resulting value at risk could be higher or lower. Sometimes it's higher because you lose diversification, but sometimes it's lower because some of those broken down portfolios falls under the threshold and you don't see the risk. Right? So there's no relationship when you do this, when you break down a portfolio. Some academics have proposed other risk measures which go beyond this, and the conditional value at risk is the one, or expected shortfall is the one that became very popular, has not been adopted by the regulators. There's one reason for that, and it's the conditional expectation of the tail, not just the expectation of the tail that has to be less than the 5%. It's there. This is something that it is known to not have the problem that when you break down a portfolio, the risk will actually disappear. The risk will always become greater than or equal than the sum of the original risks. It's super additive. And it's important that risk would be super additive. Regulators don't particularly care because it will be very hard to defend in front of a judge. That formula is much more complicated, right? And well, there's more to say, but I'll just leave it there. I'm going to end with another peek at something else, to make a connection with something else that we saw 2 weeks ago, which is how we can use Greeks to do efficient risk management. It's just one very simple example. We already did this in a sense when we did the calculation, the fast calculation of the risk of Silicon Valley Bank before rates were increased. But this goes all the way, and it is part of the risk matrix document. So it was actually a big deal. In the 90s, everybody had to be very familiar with what I'm telling you now. Not so much, but back then you had to. Which is the price of any portfolio as a function of certain risk factors is something that you can write down with Taylor's expression. That's Taylor's formula, right? It's the value today, which everybody knows, and what might happen tomorrow. And the delta is the leader of that. That's the linear approximation. And that's, by the way, how I can validate the use or the assumption that my portfolio is Gaussian, because if I assume my risk factors are Gaussian, then my portfolio will be Gaussian when I consider only the linear approximation. And for the 90s, that was good already. That was a step up from what things were in 1985. Okay. Of course, we know that's not enough, but it gives us a very good framework to do something new, which is use sensitivities, use partial derivatives to get an understanding of how the portfolio risk could change between today and tomorrow. And again, we already saw that 2 weeks ago. Well, 3 with reading week in the middle, yes? And we can reuse, in the case of linear portfolios, our formula from the sum of Gaussians to have very accurate approximations to that. And actually, these things have a name. It's called the delta normal var. There's a chapter on that, on the risk matrix document that was written in 1994. You're going to go to the to include quadratic terms. That's what we call the gamma. And you can include other terms too. If you consider risk factors to be, for example, interest rates versus equities, then you can include some of the other sensitivities. And you can use Taylor's theorem as a way to give you at least an intuitive approach of what these things are. This, of course, will not be part of the regulation. There's no way you talk to a judge like that. No way. But again, the function is to understand the sources of risk, because maybe there's something you can do about that. This is what happens in the risk engine that you have inside the bank. So that when it gets to the calculator, to the risk calculator, you've done the work before and you've learned how you could possibly minimize that risk. That's what is done in the risk kitchen, okay, inside of a bank. So it's the same formulation we have seen in the past with the risk factors, with the sensitivities, and we saw that in the case of bond duration, which is how we did the probability of default, actually the risk that Silicon Valley Bank would hold. So I've ended my historical review of risk management. We're going to take a break now. We'll take a 10 minutes, 15 minutes. We'll take a 15-minute break, and when we come back, I'll tell you about the science fiction, okay? 15 minutes. I'm beginning now the science fiction part of today's lecture. Actually, the science fiction part of the whole course. It's the only time I will be talking about science fiction. And the reason I want to do that is because I am firmly convinced, I've convinced myself over the years, that we are at a point of major change. That from a financial perspective, I put at the same level as the creation of financial derivatives in the 80s as a result of the oil crisis. What we'll be talking about today is also part related to oil, but also other things. It is actually ingrained in what's called the Sustainable Development Goals of the United Nations. But I'm not going to focus on that. This is not going to be a discussion on public policies, not a discussion on sustainability. It's not a discussion on climate change. It's not a discussion, by the way, on social justice, nothing like that. It's finance and it's risk management. That's what I'm going to be talking about today. But I want to do it from the perspective of something that I believe is going to change financial markets in a way that we've never seen before. Not even before it is going to be bigger than the tech boom, bigger than the derivatives trading. There's one number that I want to tell you, which is driving my conviction. I don't know how you extrapolate this, but for me, it's an important number. Do you know, have you ever done the calculation of the value of all the electricity we get from the sun in one day? You know what I'm talking about? We get energy from the sun. That energy can be turned into electricity through the electrovoltaic process. And if you sell that into the grid at the market price of 10 cents a kilowatt hour, it's a very simple calculation. We get about a kilowatt per square meter. You do the calculation. The resulting value is 400 trillions per day, with a T. 400 trillions per day. You look at all of the oil which is on planet Earth at market prices today is about 800 trillion. That's it. So if you are able to capture just a tiny percentage of the electricity we get from the sun in different ways, and you optimize that energy we get from the sun, the economies you can create are enormous. And we are on the brink of that. This is going to be one of the biggest consequences that AI will do for us. It will help us optimize the processes, which right now are still getting better, but they're still very primitive. So energy could become unlimited and free, so that we can optimize the things that we need, like, for example, food production. And why in a few years the idea of taking oil from the ground to burn it would look just stupid. Costly, messy, right? With that, of course, we can have digital health and all sorts of things that AI is going to make possible for us. And that's going to be your world. Mine too. But I don't think my job will be driven by that. Yours will be. So what I want to do now is I want to focus just on the financial aspects of that, just the financial aspects. This is not a course on environmental science. This is not a course on energy. This is not a course on any of that, and certainly not social justice. There are great courses on that. I want to give you a perspective on what's to come, which I know is very different from what you will hear out there. I'll give you a way to think about that. I want to start with one of my favorite historical surprises. It's very hard for you to understand how shocking this was. There was an announcement made by Harvard University and the City University of New York in 1990, May 24th, 1990. This is an article from the New York Times of the time. And that was the announcement of Harvard that they're going to divest from the tobacco industry. To make you aware of how shocking this was, you should know two things. The word divestment in the 80s was reserved for one thing: divest South Africa until the apartheid movement disappears. And second, the word tobacco industry appeared in financial circles only in one sentence: buy, buy, buy. The most profitable companies in the US in the 80s were tobacco companies. The sentence that was made famous there was, they make a product for a penny, they sell it for $1. You want to own tobacco companies. Here comes Harvard Investment Management and says, we're out. Harvard Investment Management has always been a very savvy investor, always. They have the largest university endowment in the world. And what they do sends shockwaves. So this was shocking. And I guess many people made fun of that, or this and that. But what I want to do is I want to reflect with you on the significance of that. I'm going to start by making a comparison. And this is not a comparison which is as simple as it may seem at first. So please follow me for a little bit. It's hard to find a tobacco company that has been there since 1990. But I took British Tobacco, British American Tobacco. It's a company that's been in the stock market for that while. And I want to see how the company evolved over time. I have something to tell you here. In orange, what you have here is the S&P 500 index, and in blue is the British Tobacco Company. And the graph starts in May 24, 1990, when Harvard made the decision. It may seem that it was the right decision for a while, okay? But then it may seem around the year 2005 that the British Tobacco Company did better. Then the financial crisis came and everything came down, but that's not what matters. This is not how you look at this decision. What happened around the year 2018 is far more relevant. What happened in the year 2018? What happened in the year 2018 is, I have some facts here: regulation for tobacco industry, decreased demand, competition from alternative product like vaping, and litigation risks. They all happened. and they made the tobacco industry very difficult. But what happened, which is not here, is something more important, which is the public decided they didn't like companies like that. It's exactly the same thing that happened with GameStop. Except now, it is not some teenagers on Reddit making these decisions. This is investors with very high investment power making those decisions. So Harvard was right or wrong? That question is, you can only look at it from a different perspective. It was certainly not a short-term play on the face of Harvard. Time has proved that their decision was perhaps the right one. What they decided to do is to take into account other considerations which are perhaps not linked only to profitability as it was understood at the time. We already went through the history of risk management, and we saw that something very important happened in the 1950s because we could suddenly think about risk, and investing has changed since risk came up as something we can measure. And the world of finance is always full of situations like that, where something new emerges. Sometimes you can measure it, sometimes you cannot, but it affects what people do. In this time, in 2018, this had a term, and the term was 3 letters, ESG. E for environment, S for social, G for governance. And that changed the way people invested, and the company suffered. What I have here, it's a video. I don't know if I can show it to you. It's embedded in YouTube, but not YouTube. Something doesn't let me do it, as you know. This is, let me see. Yeah, we have the video. We don't have sound though. Okay, so it's okay. I don't need you to listen to what they say. This is a picture of Harvard today, not in 1990. This is today. By today, I mean a few years ago. And what's going on in Harvard is that not Harvard investment management, but the people of Harvard are asking for a divestment from not the tobacco industry, not from apartheid. Similar video to this you could see at Harvard in the 80s about South Africa. No, they're asking for this, divest Harvard from the fossil fuel industry. And this is what people say they want their money to do. We're in the midst of that. And whether that's the right thing or the wrong thing, well, good luck trying to convince these people to change their mind. Good luck, right? By the way, good luck trying to convince the others who think the opposite. What's going on is there's a difference of opinion, and this is what creates a financial market. So let me now quote, I always quoted Mark Carney, something he said in 2021. Little did I know who was going to become. So I had to add an additional line. He's the Prime Minister of Canada, but he's a person who has had the luck, I think he got lucky too, of being the merit, but usually they are correlated, right? He's the only living person who has been the bank governor of 2 countries during his lifetime, Canada and Great Britain, and that's major accomplishment. He also has been the UN Special Envoy for Climate Action and Finance since 2019. My course is not about climate action. My course is about finance, sustainability, and risk management. I just straight that there. And this is the narrative that you have heard over and over and over and over again. He did it before he became Prime Minister. Now he will have to say something different because he's a Prime Minister now. But if I go through what the financial sector is saying, let me start with Barbara Swan. Do you know Barbara Swan? So Barbara Swan is the CEO of the University Pension Plan. He's the one who does exactly this, who manages the same company as Harvard Investment Management. She's great. You can check her out, connect with her on LinkedIn. She's great. And she's been very outspoken in this thing that she says, which is our financial systems can and must play a critical role in financing Canada's transition to a climate resilient net zero future. That's what she says. And what I'm going to be talking about now is very much aligned with that, but not as a mission statement. My discussion here is going to be a financial discussion to try to tell you something that is brewing in financial markets that I need you to be aware of. What Jamie Dimon says is I think is more revealing about what I'm going to be saying here. And the key, just read what he says. He's basically saying, look, I'm a bank. I'll go wherever the money is. That's what banks do. If there was no money in finance, he would not be there. So if there was no money in, this is about climate. If there's no money in climate, he would not be there. But he has to be there because that's where the money is. And Victor Dodek, CEO of CIBC, says something similar. He's trying to give a bit of an opinion, but this is what these people say. The banks would say this is, we're in the business of going where the money is. Barbara is not. Barbara is more aligned with the way Harvard Investment Management thinks, because she's responsible for managing, amongst other things, my pension. Okay? So this is what these people say. So how are these things happening? What's going on? And there's two events that I want to bring out to your attention. One is Kyoto 1997, the other one is Paris 2015. Paris, I think you know. Kyoto, you may not know. But Kyoto 1987 is really what started everything. By the way, this is before all of this noise we hear now about climate action and all of that. Okay, that was perhaps the first big climate summit, where what was decided there is to create a new market, to create an economic incentives to reduce emissions. People have been saying for years and years and decades that we need to reduce emissions. I said, well, great, you start, right? That was always the answer. So the concept there is, well, why don't we all start at the same time? And why don't we do the following? Why don't we create a market for emissions, where people that have to emit, they just pay those who we want to not emit. I'll give you an example. This was something discussed in 1987. What if Brazil decides to just eliminate the Amazon forest altogether? Why would they have it there anyway, right? And then just make a big airport, or whatever it is. They can create many countries inside the Amazon. Why? And then people were saying, everybody was saying, no, we don't want Brazil to do that. Well, then what incentive does Brazil have to keep the Amazon forest? Now we're getting to a very interesting question: is how much is the Amazon forest worth? Anybody knows? And by that I don't mean, I cut down all the trees and I sell that as lumber. That's not what I mean. It's very hard to value that, but the asset is there, and without the Amazon forest, we'll all be in deep trouble. Not just because of a emissions perspective, but because everything it does to biodiversity. A lot of the medicines we get are from substances which are only found there, for example. It's very hard to calculate the value of something like that. And the option pricing I've shown you here will not help. Well, there are people, that's what they do. They calculate value of things like that. And some people will argue that the value is about $30 billion, for example. Not much, right? It's the GDP of Canada is about 3 trillion, something like that. So, but then if that's the case, then maybe the people who take care of that should be incentivized to not get rid of it. And that's what Kyoto introduced. And they led to a new concept, which is an emission market, which last year became a derivative approved by the Securities and Exchange Commission. You see, just like a swap was approved as a derivative in the 80s, it's exactly the same parallel that's happening. And a lot of these things are going to create new markets that I want you to be aware of. The Paris Agreement in 2015 went beyond that, and it created a very big, very cohesive agreement amongst many countries. Now the United States has left. I think Argentina has left too, I'm not sure. And there we have Article 2.1c that, as I told you, it says financial flows will be used in decarbonization. And the minute you hear that, when 193 countries decide that they're going to do one thing, for sure money is going to flow. In what form, we don't know. Assets, derivatives, we don't know. But that's where the banks are there. And that's why I want you to be aware of this, because a lot of wealth creation is going to be there. How much? Well, if you go with my early analogy of the value of just the electricity we get from the sun, this could be much, much bigger than the tech sector that we have seen. Footnote, I created my investment company in 1999 as companies like Google, with a weird name, were coming up. And the investors were making fun of these companies. They will never be worth anything. The 7 biggest companies in the world are those now. Okay, so I've learned to be very skeptical about people's foresight. You know, so I'll give you again my science fiction. The size of these ESG markets today is more than $1 trillion. These are all numbers. I'm sure they're even bigger now. Okay, and if you look at funds which have ESG in their definition, is more than 30 trillion. 30 trillion is about the size of the United States GDP. You cannot ignore this. You cannot ignore this. China, I think, I don't know if I mentioned this to you, but China has committed to creating a market of $4 trillion, just China, on emissions market for the next 5 years. That's the GDP of Japan. Airlines, just Chinese airlines alone is $1 trillion. Okay, this is what's developing. So it's very hard to ignore. You can't ignore that. I have here a game. I'm sure you've seen this game, which we're going to play very quickly so you understand a little bit of what's going on in the world right now. This game helps us understand what's going on. I want to. You've seen it, I'm sure. So in game one, I'm going to play game one first. I'm going to give you 2 choices. I don't think I've played this game with you. I like to play this game. Every time I give lectures because it makes people understand what we're talking about. In game one, I give you a choice. In the first choice is you just take $900 and you go home. In the choice 2, you gamble. 90% chance you get $1,000, 0% chance you go home. Nothing. Empty-handed. You understand the choices, right? Good. Who chooses A? Who chooses B? There's always a gambler. 10% of the people gamble, right? Great. Yeah, okay, let me change the game. In the second game, I give you a penalty. $900 you pay me. Or allow you to gamble. 90% chance you pay even more. 10% chance you pay nothing. Okay, game 2. Who pays $900? 10%. So is 10%. Who gambles? 90%. Exactly. So what does this say? This is a lot of things. One thing it says is this is why financial markets exist, because people have different opinion. And then I show up as a broker and I realize that people have game A, game 1 and game 2 naturally. And I realize they are based on the same effect or the same risk factor, the same stock, the same whatever. So I show up and I make a market. And I make 10% from everybody. That's my job. That's where financial markets exist. This game shows why brokers make money. But in the context of what we're talking about here, let me give this a slightly different context. Let's say that I convince you we have an emergency and we have to pay $900 to leave that emergency. I said, are you sure? I said, no, I'm not sure. There's a 90% chance that we'll lose even more. And there's a 10% chance I'm wrong. What do? You gamble. And that's what you see the public doing today. Most of the people want to gamble. And a few people say, no, I'll pay the premium. I'll do what I have to do. It's going to cost me money. But then I avoid the riskier scenario, which can really get a lot worse than that. Okay, I have many different versions of this game. So when I go back and decide what Harvard did, Harvard made this decision with a similar type of thinking. Said, I can have profitability today, which will give me money. I'll buy tobacco stocks like everybody. I said, no, there's a chance that there's going to be too many lawsuits and I just don't like it. And who knows, maybe even Harvard gets sued for investing in a tobacco company, which, by the way, today would not be out of the question, right? So what they decided is to make a choice which is very aligned with the financial risk that we have seen earlier, except the risk is not the risk of losing, it's legal risk. You can be sued for something like that. And in the context of that, every risk management decision has to balance the price of time and the price of risk. And Harvard is thinking 30 years or more ahead. Every endowment, every pension plan cannot think of the best decision so I can sell my stocks and make a lot of money tomorrow. That's not how they think. All right? So that's where you have to think about these things a little bit differently. And earlier on, this was called impact investing, which is investing so that you benefit your environment. And some companies did that, and they did that by losing money. They lost about 4% per year by doing that. And some companies said, you know what, I don't care, I'll still do it. This turned into the ESG that we spoke about today, that hoping that you have some well-defined rules as to what to do the right thing. We don't have that yet. But this is what we are on a path to sustainability. Okay, and this is what we're dealing with. Let me go back to the previous game and I'll give you a different choice now. Let's say that instead of $900, losing $900 or gambling, let's say that you're at an airport, you're about to board a flight. There's a law, the federal law, that says that if there's thunder and lightning, the airport has to close. Airplanes are not allowed to fly when there's a thunderstorm in an airport with electrical activity. They're not, right? But let's say that we don't have that. And then the airline says, oh, this is the plane, you have to board. Right? And they say, I don't want to. Well, then you lose your ticket. Can I get a refund? Say, no refund. What do you do? Let's think. Okay, I'm not going to ask you for your show of hands. Let's just go through that and think. There's arguments in favor, which is to say, you know what? It's very unlikely I have a problem. In fact, there's this law in physics, Faraday's law, that says that if I get hit by lightning, the hell will just go around the plane, hit the ground, and I'm safe. And it's true. Physics will tell you that you're fine. But if you run, you die. What do you do? Sometimes I take show of hands, and still 10 people gamble. 10% of the people still gamble. So fine, I only do this so that we can actually have a slightly different argument. And this leads to a very important activity, which is going to be, I think, the activity for maybe a good chunk of the 21st century, which is risk thinking. What to do when you don't know what's going to happen. We come from a 20th century where engineering has been great. We've marveled, we can create wonderful, we got to the moon, and everything was very predictable. And the world of predictability somehow is over because now we're so good that we can actually deal with things which we cannot predict. We can deal with situations that we can anticipate. And every time you anticipate, you're dealing with things that you don't know. You're trying to do something before it happens. So this type of thinking is very important, and I can go back to the game and then I can start to rewrite the game in different ways. I'm going to go quickly through this. When you have to deal with, when you don't know what's going to happen, you have to classify your data into 3 buckets. One data is what you know. That's the engineering of the 20th century. We're very good at that. The other one is what you don't know. Things that might happen, okay? And then you can do something with that, and you can talk, speculate, measure, simulate. And then there's the things that you don't know. And that's part of the learning process. This is where all of the interesting activity happens, right? This was popularized by Nassim Taleb, a very good broker, very good trader, someone that I've followed for a good part of my career. And he analyzed this in the context of if you're a turkey and you try to analyze your life. So there's the known knowns, you have a good life, they give you food for free, you just go and do nothing. Okay? And there's the known unknowns, you don't know, it's turkey, Thanksgiving is coming, as he says, right? You don't know how long that's going to last. But then the unknown unknowns is you don't know what people do. You don't know what humans do at Thanksgiving, right? And that how your life comes to an end. So he says it's very dangerous to always look at the past, always use the rear view mirror and never think about the future, because that's where the unknown unknowns deal with. And my course now, I say science fiction, but I can tell you it's really about the unknown unknowns, with a little bit of the known unknowns and hardly anything from the known knowns, because there's where everybody knows something. So you can do, you can apply this to the Silicon Valley Bank. We've gone through this. You never knew that rates could go up by 5% in a year, and your deposits will dry up at the same time. And this is an example that will be coming out later. Let me just move over to that. And with the climate crisis that we're going through right now, I said 24, I should update, that should be 26, or maybe I'll just leave it like that, doesn't matter. There's some known knowns, things that we know, which is that the CO2 is a gas that reacts to sun rays, not the ones we get from the sun, the ones which are deflected by the earth. They react with that and makes them hot. Scientists call this in the attempt to talk to the public, they call this the greenhouse effect. I like to call it the microwave effect. It's a much better description. You use a microwave, right? And what happens when you put the plate into the microwave? The microwave has been engineered so that the wavelength of that radiation interacts with water molecules and makes them spin. And that's why everything that has water gets hot, and the plate that has no water stays cold. If it warms up, it's because the water will warm it up. But if you put some metal there, what happens? The metal starts spinning very, very fast, and that thing would explode. Who knows? The metal could get warped, right? It's exactly what happens with these four gases I have here. It's exactly what happens with them when they get hit by this deflected sun. The shape of the CO2 molecule, which is like that, okay, is going to spin very fast when it's hit by those, just like the microwave. The substance in the microwave, right? That's what it does. NO2 also, and methane too, except that they actually spin faster. It's just physics. Okay, and as you know by thermodynamics, if you spin very fast, you get hot. And you get hot, you get everything around you hot. And water does it too. Water is actually one of the most potent greenhouse gases or microwave gases, like in the microwave. But water is not a concern for people in environmental science. Why? Because the air can only take so much water. When we have too much of that, it rains. So the amount of water is almost the same. It never changes. But CO2, we have a little bit of it in the atmosphere, and we get a lot. We get a little bit more, we're in trouble. And the same thing with these other ones. So this is bad. How bad is that? We don't know. The fact of the matter is we don't know. We know that the atmosphere, on average, will get hot, but we don't know because it's a very complex system. And people have done simulations and say 25% of the time it's really bad. 20% of the time is not so bad, and the other times we don't know. But 25% for anybody that knows risk is a very big number, right? Because the severity is very, very bad of what might develop. So if you think about this in the context of risk thinking about the airplane, then if the penalty you pay is that you die, then your decision will be very different. And that's what we're confronting with. So it's all at the matter of fact, it's all about it's a numbers game. We need to know the cost of our actions and what we do about this, right? And I can now go back to the game, and I can change the numbers. I can change the numbers slightly, and then I can make a market. I can trade with you. Eventually, I can change the numbers enough so that no one will actually want to gamble when I look at game 2. And the way to make all of that factual, the way to measure all of that is exactly how insurance companies work. That's what insurance companies do. They say the mitigation cost of climate or a fire in your home is always the same. It's what you pay. Nothing comes for free. If you're going to take climate action, it's going to cost you money. If you want to buy home insurance, it's going to cost you money. And it's related to two other important variables. The loss probability and the severity. The severity is how much money you lose. And they are related in a very interesting way, All three are related. Most people think that they're related by taking expectations. If you come from the actuarial world, you know that's not the case. Expectations will always underestimate the cost, the mitigation fact. So again, this is a course on insurance, okay? The insurance premium is not the probability of loss times the loss amount, not even under the risk neutral measure, by the way, because these markets are incomplete. I cannot sell the underlying. So that doesn't work. What works is if you mathematize this in a probability space, what I'm saying is that the insurance premium is not anywhere close to the expected losses. And this will be very good training when we do credit trading, because for credit trading, we also cannot think like that. We need to understand, because a lot of the credit losses are not diversifiable, and it's very hard to sell the underlying. Okay, it's very hard to sell the underlying. So what you have to do is follow a different approach, and the different approach includes an insurance premium. Okay, I have here an example how auto insurance is done. You probably have seen this. If I have a situation where I have an insurance company and I have the expected value of an auto policy claim is $1,000, people have an accident, and I get a probability of 10% that is particular policy will submit a claim, you can think that the claim is $10,000, so everything works. How much are you charged for your insurance premium? If you charge $1,000 and you sell a single policy, then, as you know, you're in trouble, right? Because just one event will cause you a loss. And so we're in the situation of the value at risk may be very low. We saw that earlier, right? This is a lottery ticket. But in any case, we have a 10% probability of running out of business. And if I increase my premium by 10% of the expected claim, then the probability that I go out of business is almost the same. It goes down by a little bit. Let me assume that I have good diversification. I have 1 million policies. If I have 1 million policies and I charge the expected value, then there is a 50% chance I go out of business. But if I increase the value by only 10%, there's a very, very small probability to go out of business. That's actually the right amount, right? So this is how you start to mathematize all of these things, and with proper information, you can make the right decisions. So the way to price risk is always by always. The normal approach to pricing risk is to charge two types of risk, what we will call next week the expected losses, and what we call also next week the unexpected losses with a risk premium attached to that. And this is new, we've never seen that. Okay. This goes against the option pricing that we have seen in the first part of the course. And the reason is now we're no longer working for free, and in particular, we cannot sell the underlying. Okay? And this is how impact investing is really rooted on. I have here, I have a video. I'm not going to go through this video. This is the video that explains the Sustainable Development Goals. I'll just list them here for you. I don't know if you have seen them. These are 193 countries have agreed a few years ago. Now they will probably not agree, but a few years ago they agreed, 193 countries agreed that these 17 goals are important. Important to the point that they're going to mobilize assets to make them happen. How many assets? They didn't say, but I can tell you it's many, many trillions of dollars. Many, many trillions of dollars. It changes very much if you go from one country to the other. The United States, for example, was very much in favor of all of that. Now they're very much against all of that. Okay. China, for example, has been consistently in favor of all of those, and actually is perhaps today the biggest pusher for a lot of that. So let me just from that. So these sustainable development targets have turned into what we call ESG. So what the E pillar has done is take all of the targets from there that have to do with the environment and just make them a priority. Then the targets that have to do with social elements and make them a priority, and things have to do with government making them a priority. And this is exactly what Harvard did in 1990. And this is exactly what caused that drop in value for British tobacco in 2018. It's this way of thinking, and investors are thinking like that, and trillions of dollars, as I told you earlier, 30 trillion, more than 30 trillion, are now invested according to this. Okay? And some of you will get jobs where you will have to evaluate this type of accounting. It's a type of accounting. We don't have, it's accounting which is not done in numbers, but I already told you the accounting of the future is going to be with textual information, which is what machine learning can do. So this is perfect for you. This is perfect for you. And there's global policy groups which working on this and are trying to make the world a better place. The Intergovernmental Panel on Climate Change, the IPCC, the Financial Stability Board, who want to reduce greenhouse emissions, and this and that. Okay, let me just. I think I want to move a little bit faster from that. So there's 6 types of gases which they want to decrease the percentage in the atmosphere. Carbon dioxide. Water is not. We don't care about water. We're happy with water, despite the fact that it's a very high global warming agent. Methane, NO2, and then the hydrofluorocarbons, which we're familiar. I mean, maybe you were familiar with them or not. A long time ago, because they were first, these guys were first playing with the ozone layer. When was the last time you heard about the ozone layer? Maybe you never heard about the ozone layer, you're very young. It was a big thing 10 years ago, okay? No, we don't talk about that. Why? Because these gases have been phased out, and now the ozone layer is coming back. So that was expected. But there's still others which are there, which we're trying to phase out, the perfluorocarbons and the sulfur hexafluoride. And there's something called the global warming potential that tells us how much these gases get warm when the sun hits them. The unit 1 is given to CO2 because it's the most common greenhouse gas. But by the way, the reason we are at a comfortable, to talk about comfortable temperature when you're in Canada in winter, is but the Earth will be 18 degrees colder if it wasn't for the CO2 we have in the atmosphere. Okay, so it's nice that CO2 is a global warming agent. We've used it. I mean, that's why life exists on Earth. The problem is that we have too much of it, it'll be a little too hot, and we don't want what's coming with that. So methane has a global warming potential which is 80 times that of CO2. It's much, much worse. The good thing is that after 30 years it oxides and then it becomes CO2, and then it loses that global warming potential. Nitrous oxide is actually 300 times worse than CO2, and the half-life is very long, it's 100 years. This is the reason why diesel cars were beginning to be phased out a few years ago, because diesel is a big producer of NO2. And then they came up with a solution, this AdBlue, which is a brand, I don't know how you call it. If you know it, it's just an additive that you add to diesel, and then it makes the NO2 come down. So engineering has the solutions to all of these, not to all, to many of these problems. Others are financial. I want to focus on the financial, not the engineering. But once you get into these, which are entirely anthropogenic, anthropogenic means that they're only made by humans, then we look into very bad numbers. The global warming potential is huge, it's 25,000 times worse, and they're there forever, like they never go away. Okay. And these are the ones which are really dangerous. So because of that, there's a classification of the whole industrial world as a function of the contributions to greenhouse emissions. You have organizations which generate them through processes. You have environments which consume energy and heat, like us, for example, University of Toronto. You have power producers which supply energy, and all of these are entities which contribute to emissions. And I don't know if I should tell you this. This is actually the problem how I became involved in this a few years ago. That was before I learned everything else that I'm trying to tell you today about carbon markets. This is I'm going to tell you because there's something personal in this example I'm going to tell you here. This table that you have here is a table which is very well known, is the contributors, the countries, and the contribution to greenhouse emissions per year. And a very commented fact, which many of you have heard many times, is how China is the biggest contributor to emissions. Of course, they are the biggest contributor because they're the biggest country, right? Then you have the United States is the second biggest, and Canada is number 7. Now it's very interesting. Some people, what they do is they counter that argument with another one, which is if I look at the emissions per capita, this is the table that matters. Of course, China disappears because the emissions per capita are very low. They're about a third of the emissions of the United States, for example, and certainly much lower than Canada. Right? But then, this is not so much finance, but this is, as I told you, how I became interested as a mathematician in this. Turns out that neither of these tables is really relevant. Canada is a good example of that because Canada is number 7 no matter what. And the reason we're number 7 on a per capita basis is because Canada has a lot of activity which has nothing to do with the population, namely agriculture, right? And we're a tiny country. In terms of the number of people, we're very small. So when you divide by a small number, you get a big number. Right? So that's to say that doing a division, a ratio here does not work. You need something more complicated. And linear regression does not work either, by the way. So one thing that I did, and I worked with my colleagues at the Risk Lab, some of you at the Risk Lab here. This is a paper that we did years ago. The first paper we did at the Risk Lab on emissions is to do the right calculation. This is one of the people that I like to quote when I do this, is Paul Erdos. Have you heard of Paul Erdos? Mathematician, very famous. He worked on hundreds and hundreds of problems. He was, he spent his times traveling. He traveled even more than me, I think. And he spent his time writing papers with people. He had so many collaborators that in mathematics, there's a very well-known number. We call it the Erdos number, which is, if you've written a paper with Erdos, then your number is 0. You are an Erdos collaborator. And if you've written a paper with someone that wrote a paper with Erdos, then your Erdos number is 1, and so on and so forth. And the theory is that everybody has a finite Erdos number, but they are surprisingly low. I think my Erdos number is like 3, and I never met the guy. Okay, so he was a very prolific mathematician. He has a very good sentence. He says, a mathematician is not someone who knows how to add. He's someone who knows when to add. It's a very good definition of what mathematics is, and it's very good. It's giving, I think, a very good glimpse as to what your career should be. Okay, you should not be the guy who is the guy that gets called when they say calculation that needs to be made. You should be the one to decide what calculation needs to be made, right? And it's very much aligned with what I told you, how you will be involved in risk management. At the end of the day, yeah, the risk department will do the calculation and will send it to the regulators. But you want to be the one involved in how that number gets produced in the end to begin with. So one thing that we did with some of my students here is we found what the factors are, and the factors are very interesting. They're slightly different from people think they are. I'm not interested in that. I just want to tell you that once you do that, you can actually get a very good picture of all the countries and see whether their emissions are going up or down relative to the baselines, which are dictated by their own economies. So, now, on that basis now, what I want to do is I want to tell you what really matters, where I wanted to get to. I want to give you the context. Now I want to tell you the market that is developing as a consequence of this. And I want to start with, I'm going to give you 2 business cases. I'm going to end with 2 business cases which I will use to explain to you the new finance that's happening. My first business case happened in Kenya. And it has to do with a company, a Dutch company. I forgot the name. Company is called Vestergaard. My Dutch is not very good. It's actually, I don't know any Dutch, but it's called Vestergaard. Okay, and they created a product. It's called the live straw product, which is it's a water filter. And what they did is in Kenya, if you want to drink water, you have to do that. You boil it, and then you drink it, right? It's not like in China that they boil it and they eat it while it's boiling. That's different. Okay, there they boil it, let it cold, and then they drink it. And what they did is they brought the filter so that people didn't have to boil it. They just run the water through the filter, and it's produced so that it sanitizes the water. And then they've done the analysis, and they have calculated, I'll tell you exactly what I mean by that, and they have found that they are saving let's say 2 million tons of CO2 from going into the atmosphere. Why? Because people don't have to burn wood, and then you could be asking. Then you have to ask. There's two questions I want to pose here, which are the questions I want to. How do you get that number, 2.7 million? And then it's, who cares? Let me start with the first question. How do you get the 2.7 million?
You look at how much wood was being burned and how much CO2 was being.
Exactly. So you have a pretty good idea how much water they drink. You have, on a per person basis. So, well, I need so much. You can do the calculation. It's approximate, but you can do the calculation, right? And then what they did is they sold so many 880,000 filters for 4.5 million people, and that's where the number comes up. Good. So we know the number. We accept the number. Okay? The risk department can send it to, I don't know, where? God, UN, somewhere. We know the number. Who cares? Well, who cares is this. This is what I want you to know. This is perhaps the most important part I have to tell you today. Maybe this whole course is there are companies who are willing to pay you. By you, I'm not sure who now, very likely Vestergaard. They're very happy to pay you something like, I'm going to make up a number, okay? It's much higher than that, but I'm going to make up a number. It's $10 per ton. That's $27 million per year. Companies, why? Because when they do that, you send a piece of paper that said all the credit of the CO2 you have saved goes to you. This is called a carbon credit. And it is essentially what Kyoto 1997 did. I told you earlier that they were looking for economic incentives to decrease people's emissions without forcing everybody to stop emitting. Some companies just need to emit. So what if I am a company that I need to emit? I am a cement company. Cement companies do a lot of emissions because you have to heat up all that limestone to 1,000 degrees. And I do it by burning wood. I have no choice. I do that, but I do that, but with with limestone, not with water, right? And there's no limestone filter. It's not a filtering issue. The chemistry does not work until I heat it up. So what I do is I have a certain emission profile. If I buy the rights from you, then my emission profile will go down. Why do I care? I care for two reasons. Again, one reason, some countries are regulating this, and the governments are telling their companies what they have to lower their emissions by. Why? Because countries took a commitment in 2015 to lower their emissions to a certain level. Canada did it. The United States did it. Now they said goodbye. China did it. All countries did it. I have a table. You can look it up, right? So countries are doing that, and they are essentially forcing their companies to lower emissions or buy that. And for many companies, it's a very good deal to do that. So there's two reasons. One is that. The other one is I'm not forced to do that. I do it because I want to look good. Example of a company that loves doing this to look good. You know the company? This one, Apple. Why does Apple do it? They're not forced, certainly not in the United States. They do it. Why do they do it? That's the finance of the future. Why do they do it? Does it show on their financial statements? It does not show on their financial statements. Some companies, they produce an addendum to the financial statements where they actually publish their emissions footprint. Why do they do it? So people like them. It's the same as GameStop. It's the same as tobacco. It's the same. It's the finance of the 21st century. Finance has become a social game, where the accounting is no longer just your P&L, it's no longer just your earnings per share. You understand what I'm saying? And in this situation we're in now, where social flows of information and social likes and dislikes can make or break a company, many companies do it just so that they look good. It has become a financial asset. People's opinion of you has become a financial asset. Forget about the government regulating companies. People do it, companies do it because they want to. If it's cheap, they will do it. It's cheaper for Apple to do that than to run ads on television. And they do it. You understand what I'm saying? This is a financial asset we cannot see, you cannot measure. Forget about hiring an accountant to tell you the value of looking good. This is what's happening. This is where we are. And it's completely consistent with what I told you changed in 2020, when flows of opinion make a big difference. So GameStop and carbon trading is really part of the same story that's developing in the 20th century. Social finance. I call it social fintech, because without technology, there's no way you can do that. Just imagine counting, the tons of CO2 saved with traditional accounting methods. You cannot do it. You have to go home by home and say, how much wood did you burn this year? Okay, and last year, okay, you cannot do it, right? So, by the way, footnote, I'm very, very involved in that. Very, very involved in that myself. Okay, and the research that we do, and the people who are at Risk Lab, that have things going on in many. $20 million is not a insignificant. By the way, you get more than that. $10 per ton is very, very small. By the way, how many of you, when you fly, when you buy a ticket, you can neutralize your carbon? You know what I'm talking about? Have you seen that? You never fly? Okay, how many of you have done it? I don't. I do it always. In fact, I do it twice, because I do it, and then if it's travel with the university will actually charge me again. The University of Toronto has an internal carbon trading system, where every time we fly on university business, they calculate the emissions and they charge us for that. It's here already, it's everywhere, okay? Even if you cannot see it. That's the voluntary market, and there's it's called the regulated market, is the one where the government's for you to do this. I'm not gonna get into the macro structure of the carbon market, I just want you to be aware of that. And I wanna end my lecture today with a business case which is one of the most shocking I have seen. One of the most shocking. And that's the Nyaliga fire project. By the way, Australia is one of the countries which is most advanced in what I'm talking about in terms of carbon markets. Regulated carbon markets, the ones which are driven by the government. So this is a situation which is very interesting. It has to do, there's some amount of information I should give you so you fully understand this, but I'll just stay with the finance, just the finance aspects of this. So here's a picture of the Nyaliga Corporation. It's a corporation made by Aboriginals in a certain part of Australia, in East Kimberley, in northwest Australia, and it has to do with savanna fires. One of the problems, it's not a problem, it happens. We have it in Canada too. We get fires, right? Fires are things that occur. They're actually, nature needs fires. At some point, that's how they get rid of dead wood and this and that. But the thing is that fires produce a lot of emissions. So what this company has done is, I'll summarize it for you. What they do is this: they get they get funding from the government because they sell their credits to the government, and they do that because of the following. When you have fires that occur naturally, they typically occur during the dry season. And when they do, they're very vicious. They burn forever, they take a lot of territory, and they produce a lot of CO2. So what they do is they do controlled burning. And through controlled burning, you can imagine what it is, right? They decide, the engineer, where to burn on purpose. They control it, right? And in that way, what they've managed to do, so bear with me on that, they've managed to reduce the area that is burnt. They've enhanced the grass and the wildlife in the region. But they don't get paid for that. They get paid because they have lowered the CO2 emissions by 40%. And here, the reason I like to talk about this case is because I can show you how they do it, how this number is calculated. And I want this to be a revelation for you, something that I think would give you a view that proves what I told you today, that is already happening. Okay? This is how they get the calculation of the 40%. They hire a consulting company, KPMG, and they produce documents. I'm just showing you here random pages in the documentation that they produce, which is several hundred pages. This is an audit report. And you will see some documents there with formulas and this and that. So there's a bunch of humans, which are hired to get a number of information, which has been accepted. Everybody knows what that is. You need to measure the land. You need to count how many leaves the plants have, and you need to do all of that. And with all of that information, you create a report that is submitted to the agent, which in this case is the government, is verified, and then they say, okay, so you have saved 50 million tons of CO2. So here you go, market price is now $30 per ton, so you get $400 million. That's how it works. Now, let me ask you a question. And now this is the real science fiction part of the course, but you will see how close we are to science fiction. How many of you could come up with a better way to price in? Yes. The formulas that you have in these documents, which I haven't shown you, but these formulas are already established, they are known. By the way, you give these documents to ChatGPT, it's, I know how to do it. And then ChatGPT will tell you, okay, so you want to do the same for pick your region. So, okay, so give me these variables. Right? You give the variables to ChatGPT, and the ChatGPT will do it. Actually, Gemini is better. Then they will do that for you in how long? A second, 2 seconds? Right? You understand what I'm saying? This is not science fiction to you, is it? You do things like this every day. It's not science fiction. Okay, so the next question is, how can you get those variables? Well, you don't know what the inputs are, but you can imagine what they are. It has to do with the health of the vegetation, how tall it is, how many leaves, branches. After you've done a few of these, what you do is you give it to ChatGPT again. You say, well, I don't know about this region, but for this one I have that. And then go figure it out. This is called supervised learning. You say, for that region, sure. Okay. Then you extrapolate all of that. You do support vector regression, something. And then if on top of that, you can fly a few drones to get some high definition video about the place, then you can get this done in under a day. Do you know how many hundreds of thousands of dollars these documents are worth to produce? The cost is high, very high. What if you can do it faster? That's one of my companies. That's what we do. But then once you have that information, then you can treat this in days. Not in minutes, not high frequency trading, but these are the markets that are developing. And the science fiction is what? Large language models, we already have them, right? To turn aerial images into parameters that you can feed into a model like that is, I don't have to convince you, this is doable. In other areas, it's already being done. That's how agriculture is managed today, right? And what are the size of the markets which are being created? They are in the trillions of dollars. I don't know how many trillions, but a lot of trillions. And this is the finance that's beginning now. And I suspect many of you will be involved in this one way or another. That's my science fiction.